Over the course of the next few modules, we are now going to begin building out the process side of running your trading business. Mark Naverney talks about this interesting concept that there are two types of traders inside you, me, and everyone. One type is the builder, and the other type of trader within us all is the wrecking ball. Now, builders are extremely disciplined and process driven. Wrecking balls act impulsively and are driven by their ego. Builders are focused on following their procedure and perfecting their method, whereas wrecking balls are absolutely fixated on immediate results, and if they don't materialize right away, then they get discouraged. If a strategy doesn't produce winning results quickly, or it goes through a bit of a difficult period, builders are trusting the process, and that trusting the results will come over time if they get that process right. Whereas the wrecking ball, they tosses it aside and they start looking for a new shiny strategy, and they never really commit to the process. Builders have developed a mindset that allows them to view mistakes as teachers that are constantly providing valuable lessons in a continuous feedback loop. Whereas if wrecking balls make a mistake, then they start to beat themselves up about it, or worse, they look for someone or something else to blame, and they fail to take extreme ownership for their actions and results. Builders are always optimistic, so they actually look forward to the day when results are achieved, regardless of whether they are good or bad results, because they then know that their process is constantly being improved, because they are taking extreme ownership of those results, regardless of whether they perceive them to be good or bad. But wrecking balls, however, they just have an endless stream of excuses to disassociate themselves from their own weaknesses, insecurities, and imbalances, and they mask them with pride, arrogance, and blame. They rarely take ownership of the outcome, and as a result, they never build anything lasting or successful. Builders understand the power of the slight edge. They understand the power of compounding. That small and simple disciplines, repeated daily, carries you upwards towards success. Whereas wrecking balls, they fail to understand the power of the compounding effect, but it is relentless and it is always working either for you or against you. The simple errors in judgment, repeated consistently over time, it then pulls them down towards failure. They don't stick with the simple daily disciplines that it takes to get to where they want to go. Easy to do, but just as easy not to do. So if it's extremely clear that simple disciplines, repeated consistently, actually get you the result, then why is it that they can't stick to those simple daily disciplines? Well, it's actually quite simple. It's because they don't know how to look ahead far enough along the curve to see the results that they are creating now. It's really, really hard to see the effects and the fruits of your consistent actions and your disciplines in the short and even the medium term. It takes a really good while for the exponential effect to kick in and really start to take off. But whether you see it or not, those results are coming either way. And we all have both of these types of traders within us, but we need to focus on our processes and perfecting our methods so that we can have the power of the slight edge working in our favor rather than against us. See, traders often say that one of their goals is to have consistency in their profits. They want that 10% month or that 20% month every single month. They have this idea of a nice smooth upward equity curve in their minds, right? Now, while that is without a doubt, it's a pretty nice goal to have and to aim for, it's kind of debatable to what degree this is actually achievable in reality, to generate a fixed monthly return. And of course, over what period of time? Because we know in Photon, we know that due to the very nature of trading, results vary because it follows a random distribution model. Each individual trade has a random outcome, but over the long term, our edge plays out. So your trading account balance, it experiences short-term fluctuations in P&L, but then when you look back after a long period of time, and you look at, say, the monthly or the quarterly average of your results, then you can start to see more of that smoothed equity curve. But of course, when you're in the middle of that, day to day, month to month, you don't always see it like that. And this can drive some traders insane when they just struggle to zoom out and focus on that bigger long-term picture. And they're just way too caught up in those day-to-day fluctuations. Because if you remember this slide from the lesson that was called Are You Destined to Fail in the Trading and Edge module, then this is a list of all of the common mistakes that traders make. And it's all due to your inner caveman brain taking over in order to try and protect you, to help you avoid any of those perceived pains, just because it wants you to survive and win at all costs. But you cannot bring that into the markets. You're bringing that ancient brain to the game, And your emotional caveman brain, remember, it sees all uncertainty as a threat. Everything uncertain was a threat and a danger to our ancestors. And that's the brain that you're bringing to trading, and it's activated by stress. But as traders, we actually need to embrace uncertainty. We need to learn how to accept the risk and then take the risk, or because you lose the chance of that reward. Now, your brain's short-term survival orientation is going to try and compromise your need to take that long-term perspective in order for your edge to work in the heat of the moment. And 80% are blowing up because they're sitting there in front of their computers and they're pushing their own agenda, thinking, I'm going to win, I've got to win at all odds, I can make this thing happen. But what in fact you notice, when you're trading, is we obviously do not control the outcomes of trades. We don't control whether or not we win or lose. We don't control whether or not we are right or wrong, because we are engaging in randomness. We're engaging in the uncertainty of the markets. But what those losing masses don't realize is that the more that we value those things that are outside of our control, then the less control we have. We have zero control over the market. Absolutely zero. But yet many traders, they're constantly focusing and obsessing over the outcome of individual trades. But if you are searching and aiming for that consistency in your results, it's far better to aim for consistency in other areas of your trading that you actually have control over. So what can we control in our trading business? Well, we can control our consistency in personal preparation. We can control the consistency in our daily pre-trading routines. So with this aspect of my own trading, I kind of like to always ask myself that if I were investing my own money into someone else to trade for me, would I be happy if they prepared for the trading day the same way that I just did? And that little thought exercise, that kind of really helps me to hold myself accountable to a really high standard, but also consistently. So what else can we control? Well, we can control the consistency in our processes for market analysis and trade selection, because we follow a systematic framework for analyzing our charts, and of course we have a clear mechanical criteria for actually entering our trades. We can control the consistency in our process for risk management. We hold the power to choose our position sizing. We make the decision to use a stop loss or not. We decide where we place that stop loss. We can control our consistency in our processes for trade management. We decide if and when and where to set take profit orders, if and where to take partial profits, if and where to trade our stop loss, and if and when to manually exit a position. We can also control the consistency in regulating our emotions. We're human. Obviously, it's okay to have emotions, but we just have to observe our emotions and use techniques to regulate them and actively choose not to act upon them, so that we train our mind to accept probability-based decisions. And we also control our consistency in routines for both recording and reviewing our performance. And we can then use that feedback to drive further growth and development into all of those aspects of our trading business that we are personally in control of. Now, what is really interesting is that if you achieve consistency in those areas that we just went through, you may give yourself the best chance possible of achieving consistency in your results over time. Because then you are no longer trying to win or lose, which you cannot control, because those are simply just expressions of uncertainty. Instead, you are focusing on your performance, which you can control. And that is the psychological edge that is needed to drive your method edge, your strategy edge. And then losing only becomes, it's just landing on the wrong side of probability, relative to you. There is no need for excitement or dejection. It's only the management of probability that matters. Consistent, efficient, and conscious daily effort, whilst maintaining, a detachment from outcome-based thinking, that is the pursuit of excellence and mastery of your craft. That's a very long-winded and fancy way of saying, focus on the process. You need to be getting up every single day and just focusing on ticking off your 3 daily high priority actions that are getting you closer to your long-term goal, so that you are focusing on the process side of your trading and not the short-term outcome-based results. Now let's talk about the nature of process then, and the importance of valuing good process. So there is any situation, the position that you see that someone is in. So, we see someone up there and that is what is visible to us. But what often, isn't so visible is the process that created that position that holds that position up in place. So this down here is everything that exists below what you see visible up here. Everyone can see their position, but not what has put them up there. So it's essentially the iceberg metaphor, right? And the reason that that metaphor is super interesting and so commonly used by people is because it really is about the stuff that you do when nobody can see you. And that is what actually makes the difference. So for example, maybe you'll go on YouTube and you'll watch a nice motivational video, maybe you'll watch another 30 videos after that, but ultimately that's not going to change your position, right? It's everything you do behind the scenes. The work you put in, the hours studying, journaling, backtesting, tweaking, refining, the decades of practice of your craft is what actually reinforces that position up there. I think, there's a bit of a common tendency for people to try and position themselves high up here without first building out kind of this solid foundation below. Because all of this stuff that exists down here is what makes you, what produces your results, and it's what gives you your edge over time. So if you are not investing your time, your focus, and your energy down here on the process, then you're just desperately trying to increase your position, up at the top. Maybe it might work for a little while in the short term, but ultimately there's nothing solid underneath to hold it up. So guess what? If you are not building down here, eventually you end up having to start all the way down at the bottom again. Now, up until now, you've learned the fundamental basics of what trading is, how the market operates, how to manage your risk, how to understand probabilities and what trading an edge actually means, how to analyze price action, and finally how to both enter and exit the market. Now, over the course of the following few modules, we're going to focus on applying all of that knowledge into the process side of running and operating your trading business. So those are the processes that are the backbone of your business, and they are the foundation that determines and upholds your position up there at the top. So what I want you to think about is, if an investor was going to invest in a company and they were going to buy up a large share of that company's stock, what do you think they would look at? Of course, yes, they would initially look at the headline, profit and loss figures of that business, but that's only just one tiny part of it. They're going to want to look at the full business plan. They're going to look under the hood and examine all of the inner workings of the business, right? The operational procedures, the long-term strategy, the research and development department, the systems, the software, their intellectual property, all of the contracts and agreements that they have in place. And why would the investor want to inspect and audit all of that before they commit their money to the business? Because if they can see all of the inner workings of the business, the processes, the methods, and the systems that are in place, this will give them a much better understanding and more accurate assessment of whether the current profit and loss figures are actually sustainable, or maybe if they've been produced from a bit of luck, and they want to see if that business's position in the market is actually held up by a solid foundation, or if it's just hot air and the house of cards is about to come crashing down. But they also want to get an accurate future profit and loss projection to see where that business might be heading, because both the current and the future profit and loss of the business, those are both an outcome of the current processes that are in place within the business. So that's what the focus of these next few modules are going to be on. And we're going to get the process side of your trading business absolutely nailed down. Process beats mission. Deciding that you want to be, in the Hall of Fame, that is not the same as deciding that you're going to spend every single day doing what it takes to become a better player. The hard part isn't visualizing the win at the end. The hard part is winning when you don't love the game. So fall in love with the process and not the end result that you desire. The process is the prize. Amateur retail traders severely oscillate and struggle between two opposing emotions. To explain this, we're going to look at two traders. The first trader is Retail Robbie, and he represents the emotion of indecisiveness. Now, when you're trading and you're looking at the market, have you ever felt just a little bit of creeping doubt and then started to hesitate, wondering, should I enter the trade and get involved? Is it ready yet, or am I too early? Maybe I should wait a little bit longer for just a bit more confirmation, but I don't want it to go without me. Or maybe, have you ever struggled deciding how to manage a trade that you were in when you don't know whether to hold the trade or close it down and take what profit is currently on the table just in case it reverses against you? But then what if it continues going in your direction? Well, you don't want to miss out on all of that potential profit, so you hesitate and you agonize over what the right decision is. Because I know I used to feel that doubt and hesitation all of the time, where I was never quite sure what the best decision would be. And to be honest, it just used to make my trading so unnecessarily stressful. It just was not enjoyable at all, and it was starting to make me fall out of love with trading, really. Because it's only when you have the benefit of hindsight that you then realize when you look back, of course I knew I should have bought it. Or I knew I should have sold right there. Of course I should have held the trade. It was obvious it was going to keep going. Why didn't I just leave it alone? I'm an idiot. You know, as they say, hindsight vision is 20/20. It's always crystal clear after the fact. Now, do you ever experience these emotions in the market, if you have been trading before? Because the majority of losing traders, or even those who are just struggling to find consistency, they are constantly fluctuating between those two poles of indecisiveness about the future and then regret over the past. And they're constantly hesitating and doubting and then being frustrated afterwards when they see the outcome of their decision. And they're indecisive because they're constantly trying to predict the future, but then they look back on the past with regret. So think of this as a swinging pendulum from left to right, with amateur traders constantly swinging back and forth between these emotions in the market. So how do you stop this back and forth rhythm between hesitation and regret? How do you transcend these two poles so that you can make your decision making as objective as possible? How do you get to the point, up the top there, where you have absolutely zero doubt or hesitation before making a trading decision, so that you never feel regret in hindsight after you have made that decision, regardless of the outcome of the trade? Because down here at the bottom of the diagram, this is where the masses play, the masses of losing traders, and up at the top is where the professional traders are. Those top 10%, the ones who are consistently making money year in, year out. So how do you get up there, where you have certainty in the market and you never feel doubt, hesitation, or regret? How do you separate yourself from the losing masses and become a consistently profitable trader? Do you want to be a hindsight trader for the rest of your life? I've been there thinking, I knew I should have sold there, but you know what, it's okay, I'll make the right decision next time. Then you're stuck in that cycle and you never quite seem to get it right consistently. And then that creeping doubt in your approach that you can feel deep down, it then never quite goes away. Or do you want unwavering certainty when you approach the markets every day? Now, I don't mean certainty in that you're going to win every trade. That's a complete fantasy, of course. I'm talking about having the certainty that you are making the correct decision every single time, with zero doubt or hesitation. So how can you be so certain that you are making the right decision ahead of time? Well, there are two types of trading strategies. The first type of strategy is called discretionary trading, and this is decision-based trading, where the trader decides which trades to take based on their own judgment and current market conditions. So as you can see in the diagram, from the starting point of analyzing a currency pair all the way through to actually executing an order, you will go through a decision-making process. Now, discretionary traders, they will make all of these decisions based on their own human judgment. Now, the major problem with this approach is that the more discretion you apply to your decision-making process in the market, then the higher the chance of you making emotional mistakes. So how do you reduce the chance of you making those emotional mistakes? How do you stop feeling doubt? How do you stop feeling hesitation? And how do you stop feeling regret in your trading so that you can be in that top 10%, so that you can be a consistently profitable trader? Well, if you can replace as many of the individual steps in your decision-making process with extremely clear, rules-based and mechanical criteria, then you will drastically reduce the chance of you making an emotional mistake. Now, the second type of trading strategy is what's called a mechanical strategy, which essentially is just rules-based trading. So instead of the trader deciding which trades to take based on their own human judgment, instead the trading system decides which trades to take regardless of what your human bias may think. So if you think about programming your trading strategy into a computer algorithm, then you need to give it a series of binary questions that only have a yes or no outcome. So that essentially it follows an if-then process. So an event will occur in the market, you will then consult your plan to see if it meets your criteria. If it ticks the first box, then you move on to the next criteria. If it doesn't meet that criteria, then you simply do nothing and you move on. Otherwise, if it does, then you just simply work the whole way through until the setup has met all of your minimum criteria, and then you can just simply execute the trade. No doubt or hesitation. Now think of the market of a game like Pac-Man. I'm sure you're all pretty familiar with how that works. So each of these hollow circles, they represent a trading decision that you must make to progress to the next step. You have practically unlimited possibilities of getting from point A to point B in the markets. There is no map. It's down to you to choose your path. What entry signal are you going to use to enter a trade? Will you wait for a supply and demand zone to form? How will you define that that zone is valid? What type of order will you use to enter the market? Where are you going to place your stop loss? How will you manage your trade? Will you leave your stop loss open, or will you move it to break even? Will you trade your stop behind price or set a take profit order, or a combination of both? If you do trail your stop, how many pips behind price will you trail it? If you set a take profit order, where will you place it? On the next key structural level? How do you define a key level? How do you draw them consistently the same way every time? How many pips in front of that key level will you set your order? Are you going to scale in? Where and how will you scale in to add to your position? Okay, so I think you get the picture. There are many decisions to make when we're trading. So it's down to the trader to set their own parameters ahead of time with a clearly defined rules-based strategy. And this eliminates as many of the open-ended possibilities, and it gives you that narrow course of action to take. So you simply make the same decisions over and over and over and over again. Having a mechanical strategy, of course, won't guarantee success on every trade, but what it will do is it's going to help you to manage your risk, minimize your losses, and nail down and secure your profits, and handle unexpected events with decisive action, which over time will drastically improve your chance of success. By clearly defining your trading parameters ahead of time, you are establishing a basis for knowing whether your strategy and your edge, whether it's actually working or not. And then you can accurately refine and optimize it over time. So let's look at two different traders. The first trader on top, they have a clearly defined systemized trading plan with very strict rules. There is a clear set of criteria that they tick off to make every single trading decision, so that they make the same set of decisions over and over again. Now the second trader, they utilize a much more discretionary approach. So they know they have a couple of rough styles that they utilize to trade the market, and within each of those styles, and they've got a lot of options open to them at each level. So they've got many different entry confirmations, just for the same setup. It's very open to subjective interpretation. Sometimes they trade from the 50% Fibonacci level, sometimes from the 0.618, sometimes they just use an EMA. They kind of just randomly pick where to place a stop loss of where it looks pretty safe to place it. They'll use horizontal support and resistance levels, but they don't have a fixed systematic process for consistently placing them. They do not have a consistent mechanical method for identifying areas of interest on the chart that they consistently repeat with accuracy. Sometimes they'll try their stop, other times they'll just place a take profit order, but they place it in a different area every time. Sometimes they'll just manually close and exit a trade if it doesn't look right, whatever that means. Now, both of these traders, they both experience 4 losses in a row. Now, hitting 4 losses in a row is perfectly normal and expected, even if you have a strike rate of 75%, which is a really, really good strike rate. It's very likely that these losses are just simply part of the probability model playing out. But if you take 4 losses in a row, how do you actually determine if those losses are simply just a part of your probability model, or if you had made mistakes or just executed bad trades that you should not have taken? How do you actually determine that? Now, consistently profitable traders, we have a deep understanding of something called random distribution, right? And we know that the outcome of any individual trade is actually random. But on a collective basis, when you have a larger sample size of trades, just the exact opposite is true. If a large enough number of trades are taken, patterns will emerge that produce a consistent, predictable, and statistically reliable outcome. And that is your true trading edge. It's just logical basic math. There is no way around it. And do you remember the 2 layers of beliefs that professional traders hold? That on the surface, they do seem to contradict each other. And the first layer is the micro level. Remember, at this level, you have to believe in the uncertainty and the unpredictability of the outcome on each individual trade. And the second layer is that macro level. And at this level, you have to believe that the outcome over a large series of trades taken is relatively certain and predictable. But here's the major key. Remember, it's the ability to believe in the unpredictability of the game at the micro level and simultaneously believing in the predictability of the game at the macro level that makes the professional trader effective and successful at what they do. They have learned and completely accepted the fact that they don't know what's going to happen next. No one does. But more importantly, they don't need to know in order to make money consistently. They don't care. And that's why they don't feel hesitation or doubt in their trading. So if we go back to our 2 traders, the mechanical and the discretionary trader, who both just took 4 losses in a row, which trader do you think is going to be sweating more? Which one is starting to panic and doubt their strategy or even begin to doubt their own ability? Who do you think is now more likely to be hesitant and make an emotional mistake? Who is more likely to skip the next trade out of fear or take a low probability or even random trade, to try and make their losses back as soon as possible? Is it going to be the trader who can analyze those 4 losing trades and clearly see if those trades met all of the defined criteria of their strategy, who can then see that those losses were actually just in fact valid trades that are a part of their strategy, and therefore those trades are a part of their probability model, and those losing trades were simply a cost of doing business? Or will the panicking trader be the one who has no real idea if those losing trades are a part of their probability model, or if they were simply just bad trades that should never have been taken and those losses could have been completely avoided? I think it's pretty obvious that the discretionary trader with that subjective approach is the one who is most likely to be feeling those negative emotions and is therefore most likely to make an error next. Now, obviously, without a reference point based on clearly defined and sound rules, you have no way to measure the outcome of your trading decisions, and therefore you have no real idea if things are going along as planned or if there is a real reason for concern. You need to eliminate the variable that is you, and the only way to do that is to make consistent decisions that can be measured. Now let's put some numbers on the situation so we can see exactly why this is such a major issue for losing traders. So after those 4 trades, both traders are down, let's say minus 4%. Now when the systematic trader looks back and they review their trades and then they see that they followed their plan perfectly, they ticked off every single criteria in their trade plan, they're going to have way more confidence to continue to execute with minimal emotional interference. And they take the next trade, which is a 5% winner, and they see their edge playing out. But the discretionary trader, they've been doubting and hesitating after taking those losses, and they can't face the pain of another potential loss, so they skip their next setup and they miss out on the winner. Now that they see their trade play out, they're frustrated they missed it, but they have a bit more confidence, so they execute the next trade and they catch a 2% win. Now, you can see after those 6 trades, the trader with the systemized approach is sitting on a net 3% profit, while the discretionary trader is down minus 2%. And this is what I see happening again and again with so many traders who are just struggling to find real consistency and stop doing the break-even dance. Because when the mechanical trader, when they review their trades and they look back and they see that they followed their plan perfectly, they're not going to hesitate or doubt their next setup, and they're the ones who are going to catch their next stream of profitable trades and march onto new account equity highs. But whilst the discretionary trader, they're just going to keep digging themselves into a deep drawdown, or maybe just continue playing that break-even game for years and years, never really going anywhere, wasting their time, energy and money. Hesitation kills traders. Once you have a mechanical and a systemized strategy, the level of emotion that you will feel in the market after just taking a few losses will be drastically minimized, and you will then be able to execute with ruthless decisiveness and extreme clarity. No one likes losing, obviously, right? But imagine for a second a world in which you do enjoy it. How is that possible? Well, when you do have a systemized edge, as long as the losing trades perfectly met your strategy criteria, then you know that each loss is bringing you one step closer to your next profitable run of trades. Now, I used to struggle so badly with this before I changed my strategy, where I would take a few losing trades, but then because I didn't have an extremely systemized approach, I would start to doubt and hesitate my own ability, so I would naturally skip trades because I couldn't face taking another loss because I wanted to quit my job so badly, so I wanted to become a full-time trader. And then every single loss that I took, each loss felt like a direct threat to my plans to try and escape my 9 to 5. But then because I skipped trade setups to avoid that potential pain, I would then inevitably miss those winning trades. And then after feeling the pain and the FOMO of seeing those winning trades play out without me, I would then revenge trade by rushing into poor setups, which I'm sure you can guess, of course, would just end up losing me more money. So then I was stuck in this never-ending death loop, which was feeding off itself because I was just so desperate to make it. But all I had to do was simply change my approach to break out of it. Not having a proven defined edge is very likely the root cause of most losing traders' problems. Because if you were playing poker, would you bet on a hand if you couldn't see your cards? Of course not. Why on earth would you do that when you can't see what edge you have? You have absolutely no idea what probability you have of winning. It's just pure gambling with zero edge. But so many traders in the markets are essentially betting on hands when they don't even know what cards they are holding. It's insane. Do not be a blind trader because you do not have to be. Having a very discretionary and subjective approach to trading is tough in your psychology. It's very easy to second guess any decisions that you have to make in the market, but it's also extremely hard to accurately test and journal your strategy. Because how can you have any certainty if a trade is actually valid or not? People can overcomplicate trading, but we know that the path to success is very clear. You must have a systemized strategy that you can consistently execute and easily test. This way that you can prove your edge with data. And then once you prove it with cold hard data, that is the only way in which you will have a bulletproof mindset. And once you've developed that bulletproof mindset, you will then not make those emotional mistakes. Because it's only once you cut out those emotional mistakes and those slip-ups that you will then start to enjoy those consistent results that you desire. Because then you have a sustainable strategy because you're executing the same crystal clear setups again and again, managing the trade the same way every single time. And that is when you actually have the solid foundation built upon which you are now ready to rapidly scale, acquire investor capital or funding from a prop firm, and you can very quickly scale to multiple 6, 7, or 8 figures. The sky truly is the limit. Many traders moan that, it's the lack of capital, which is the reason why they're not having any success. But let me ask you this. If you were given a £1 million trading account today, are you ready to comfortably trade it? Be honest with yourself. Would you be able to confidently risk £10,000? So that's 1% risk on a £1 million account, right? Would you be able to confidently risk 10 grand on the next trade with your current strategy, with extreme confidence and clarity in your approach? Because if you're not, then you will never be able to scale until you have extreme confidence and clarity in your proven edge. To be able to eliminate any hesitation and doubt when you're trading, so that you can act with ruthless decisiveness, you must have a consistent, repeatable, and scalable approach so that you can snap out of the break-even dance and start to rapidly compound your growth. You see, all trading strategies fit somewhere along this scale, from 100% discretionary, where the trader literally has zero framework but just decides with their gut instinct, all the way up to 100% mechanical, where you can literally use an algorithm to execute the strategy for you. I personally think that the sweet spot for trading is around that 70 to 90% mark. And this is where you will enjoy all of the benefits that we have just discussed from having that mechanical and sort of very systemized approach, but it will also allow you to avoid some of the drawbacks of being 100% mechanical, because you still need a little bit of room for human judgment. And it's actually that small element of human judgment that is required that actually gives us an edge over algorithms. And that's why algorithms, they tend to, they can work really well in the short term, but they nearly always eventually blow up unless they are constantly tweaked and refined by human input. The market is a dynamic environment, which is always constantly changing, so we need to adapt with it. So how can we make our strategy mechanical? Well, there are 4 main areas that you need to fix. First being trade entry, the second being stop loss placement, the third being your trade management, and the fourth being risk management. So now we're going to get nice and practical, and we're going to dive into each of these 4 areas to kind of look at how we can make them more mechanical and systemized so that you can start getting results. So trade entry, you must enter the market the same way consistently every single time. So essentially, we always look to enter on supply and demand zones, right? Okay, sounds pretty simple. But what type of order are you going to use? Are you going to set a limit order? Or are you going to wait for price to enter the zone and then hit an instant market order? What time frame are you going to use for your entry execution? Are you always going to use the same time frame for entries no matter what, say such as the M1? Or are you also happy to use the 15 seconds, as well? Or maybe you just want to use risk entries on the M15 zones, for example. Whatever you want to do, just make sure you define which time frames are valid for you, and if it is more than one, and in what circumstance it is valid to use another time frame, just so you're not constantly jumping all over the place. Are you going to only use flip zones, or are you only going to use structural zones? Or maybe you're going to use both, so you're going to use zones that cause flips and break structure. Does it need to be a sweep zone? So does the zone need to take liquidity when it was created? Does the zone need to have inducement in front of it? Does your entry zone need to be in the premium if you are selling? Or does it need to be in the discount if you are buying? And if so, what time frame are you going to use to determine if you are in the premium or the discount? For example, you might be trading M15 POIs, right? M15 zones, but you're using the M1 for execution within those M15 zones. So you might use the M15 range to determine if price is in the premium or the discount. Now, when you draw your zones, are you always going to take the entire buy to sell or sell to buy range? Or will you refine to a pivot or a single candle or even a fractal refinement? Where on the zone are you going to enter? Will you enter on the distal, the front edge of the zone, or will you always enter on the EQ? Or will your entry depend on how big your stop loss size is instead? You must be as specific as possible because there is no other way to be consistent with your approach. So just make sure that you don't leave any details out. So the second key area to look at is your stop loss placement. So you need to develop a fixed formula for consistent placement. Now there's multiple ways of doing this, like anything in trading, but we always place our stop loss behind the supply and demand zone that we enter on as an absolute minimum. But what I would advise is that you define the exact number of pips, that buffer that you want to give your stop loss behind the zone. Just to account for spread, and sometimes if there's slight spikes of the zone, just to make you kind of consistently do that way every single time. So it could even just be half a pip, whatever. It obviously will differ on kind of what time frame you're on and what pair you trade. So you can also use a fixed stop loss for each individual pair you trade. So let's say with euro dollar, once you've obviously tested your strategy, you may find that over a large sample size of trades, that actually 3 pips is the most optimal stop loss size to always use. But then maybe for a pair like pound yen, which is typically quite a bit more volatile than euro dollar in terms of its average true range, which just means in terms of how many pips it moves a day, you may find that 6 pips is actually the most optimal stop loss size. So now you have a fixed, mechanical, consistent way of sizing your trade every single time, leaving no room for uncertainty or hesitation. And a final way is just to use a fixed stop loss behind a swing high or the swing low. So instead of just protecting your stop behind the entry zone, you may also want to cover the actual swing point. Just in case price pushes further towards the extremity of the zone, you might increase your odds of actually staying in the position. Obviously, this will probably likely sacrifice your risk to reward a little bit, but it may boost your strike rate. But just again, make sure you define how many pips behind the swing that you will place it. And of course, this could differ from pair to pair and what time frame you're actually entering on. Now, once you have a fixed method for stop loss placement, it's obviously going to be far easier on your emotions at times where you might only literally just be stopped out by even a micro pip before price then reverses in your favor. But then instead of looking back in hindsight and saying, I should have just had a slightly wider stop, and then sitting there counting all of your missed potential profit, instead you will be assured in your approach because you followed your plan perfectly and consistently. Now, of course, if you find you keep only just getting stopped out, then you know exactly what part of your plan then needs refining and optimizing, and it makes it really easy to adapt and improve your strategy because you have that consistent approach that then you can look back on and just tweak that little bit, right? And obviously you can't do that when you have a subjective and inconsistent approach to placing your stop loss. Remember, we are trying not to be hindsight traders. So the third area is trading management. And if you could hypothetically only make one area of your trading strategy mechanical, then this would be it. Now, why do I say that? Well, it's because of after working with many traders, I've seen that a lot of them, they have the ability to pick out and enter really, really great trades. But what separates out those who get, those great returns are the ones who can consistently manage those trades well. So once you have entered a trade, obviously your emotions are going to be pretty high because you now have your capital at risk, and wherever money is involved, we tend to make quite irrational decisions, right, as humans. So if we have that mechanical management strategy where we can simply just follow the plan like a robot, then this can help to eliminate any room for those potential emotional mistakes. And also, there's no room to be annoyed if price continues on further after you've actually executed your trades and exited, because you know that you're going to manage the same way every single time. So it helps you to eliminate that feeling of greed and dissatisfaction in the short term because you will see the long-term benefits from that consistent management approach. So what are some of the ways in which we can do this? Well, we can use a fixed take profit order based on a risk to reward ratio. So for example, you may trade a fixed RR of 10 to 1 where you use no active management. So you are either stopped out for a full loss or price hits your target. Or maybe you want to move your stop loss to break even only once price has reached 5R running profit, for example, right? So you can start to get a little bit creative here. Now, the way that you would calculate your actual profit target is you take your stop loss size and then you obviously multiply it by whatever your chosen reward to risk ratio is. So let's say your stop loss was 5 pips and then you're targeting 10R, you would then set your take profit order 50 pips away, right? 10 times 5. Now, another way is setting your take profit order on a key level. So you can target an unmitigated supply and demand zone, or maybe a weak swing high or low, or any obvious liquidity points in the market where we expect price to pull back or reverse. But again, you must have a mechanical way for drawing and identifying your key levels on your charts for this to work. Now, the other way, which is one, as you guys know, I wouldn't really recommend personally, but you can actively manage your trade by trailing your stop loss behind the swing highs or lows and just simply following the trend. So this way, in theory, you should be exiting on the trend change, right? But as always, you must be extremely specific. So how many pips in front of your key level will you set your take profit order? How many pips behind the swing high or low will you trail your stop loss? What time frame are your targets going to be based on? Are you targeting the 4-hour swing high or low, or just the M15, for example? Or are you going to use both? If you are going to use both, then you need to define in what situations you are targeting the 4-hour and when you will just use the M15. Or if you're using partials, how much volume are you going to partial at each of those levels? You don't just want to be doing this, kind of based on your gut feeling when you're in the trade. You need to have this all laid out and written down before you're even looking at the charts to trade each day. Now, the final main area to look at is one that I think many traders don't really spend too much time considering, and that is risk management. Because professional traders, they understand random distribution, right? That no one knows the sequence of their winning and losing trades, so they always keep their risk constant. So make sure that you are always using a fixed position sizing, risking the same percentage of your total account balance on each trade. Define how you will scale in. Will you only do it once the risk of your initial position has been removed? How much will you risk per day? You can define this by the max percentage of your total account balance, and then the same for your total open risk. So this is how many trades you will have running at one point with stop losses fully open. So just make sure you define all of these ahead of time and you consistently use fixed risk. So to summarize, if you enter the same way every time, you use a fixed formula for stop loss sizing, you manage your trades like an algorithm, and you use fixed position sizing, then fixing these elements of your trading, it will allow you to accurately measure and optimize your strategy performance. Only when you have a clearly defined strategy can you actually identify the bottleneck and then fix, tweak, and improve your strategy. It's how you can adapt to the constantly changing market environment and actually stay ahead of your competition in this zero-sum game. If you want consistent results, but the market is random, then be consistent in what you can control and be a slave to your strategy. You don't need to try and predict the markets. You just have to try and be in the markets every time a high probability trade setup by your plan is provided. A trading plan pretty much does what it says on the tin, right? It's essentially just a document that describes your systematic approach to trading your defined edge in the market with your entry, exit, and risk management rules. So in simpler words, your trading plan is just your trading strategy written down pretty much, right? Now, you will have this plan either printed out on your desk or on the wall beside your computer, or at the very minimum, have it on your Notion dashboard, just to make sure that it is somewhere that you can easily access it, especially all times when you are trading, because you will be reading this before and during every single trading session so that it is constantly at the forefront of your mind, because this literally will be your trading Bible. Now, over the course of the next few modules, you are first going to create your own individually tailored trading plan. And this will initially be a very rough and basic plan because you have not yet had the opportunity to actually test your plan, to trade it, and to figure out exactly how you want to trade the strategy. But before you can actually start that process of testing and trading, you obviously need a plan as a starting point, right? Because you need that plan written down, first in order to actually be able to test that plan. You can't just start firing into any old trade that maybe you think resembles the strategy, because that's just going to be a recipe for disaster. And any data that you might be collecting, it's going to be pretty much irrelevant at that point, because the data is not a part of a defined strategy. So the first step is just to get your very, very kind of rough first draft of your plan written down, and then everything will build from there. So once you have that first draft, you will then begin the testing phase, which is what we will cover in depth in the next module. And then once you've tested it and you've collected data to prove that it does have a profitable edge, you can now begin to start to trade it in the live market and see how you get on. Then as you gain more experience, you gain more data on how your trading plan, how it actually plays out in the market, you can then refine your plan, make improvements and evolve it based on that hard cold data that you have collected to actually improve your edge even more. And then finally, you will then create your next version of your plan and repeat the entire process. And this process will continue for the rest of your trading career. Your trading plan is, it's literally a living and breathing document, which you will always be evolving as both yourself and the market evolves with it. Now, obviously, when you create a new plan or even just a revised version of your plan, and once you've tested it, you don't have to start trading it live or on demo straight away. You, of course, can keep refining your plan based on your testing data until you get it to a stage that you're pretty happy with, and then you can start to trade it live once you've got it to that point. So that's pretty much the journey that we're going to go on together throughout the next few modules. Now, if you can't describe what you are doing as a process, then you don't know what you're doing. So your eventual goal is to have a full flowchart diagram that describes the complete end-to-end process of your strategy with an if-then and a yes-no format, so that a robot could almost literally execute it for you. Now, as you've probably experienced and been thinking as you've been going through the technical analysis lessons, that there is quite a lot of moving parts to the strategy, and it definitely can be pretty overwhelming when you're first learning this style, especially if you are brand new to trading in general. So creating a trading plan, it can seem like quite a daunting task because your level of understanding and your experience with the strategy, it's still in its very early and premature stages. And don't worry, that's absolutely normal and okay. So, don't worry or stress about that. But if you follow the steps as laid out in this course, if you continue to study the content, and if you continue to put in the hard work, it's literally only a matter of time before it will all click and it will all become extremely simple and second nature to you, whereby you achieve that fourth stage of competence. Remember, that's when you are unconsciously competent, where you can drive your car home without even thinking about it. You will get to that point with your trading, but then you can literally boil your trading plan. You can boil it down to just a few key words that you look at before and during each training session. And those key words of kind of your simplified training plan, that will encompass all of the detail and the complexity of your process that you now subconsciously understand. But simple can be harder than complex. You have to work really hard to get your thinking clean to make it simple. But it's worth it in the end, because once you get there, you can move mountains. So I knew someone who was a chef, quite early in their career. They had a bit of a tendency to make their dishes extremely complex because, understandably, they thought that was how things worked. More stuff on a plate must equal more skill, and therefore, surely that must lead to more rewards, right? But then this young chef, he went to a Michelin-star restaurant, and at the time, it was regarded as one of the best in Europe. And the head chef at this restaurant, he was a fair bit older than him, and he had been in the game for a very, very long time. And this Michelin-star chef, he only ever put just 3 things on the plate. Just 3 things, nothing more. And the simplicity blew the junior chef away. But more than that, it was the level of execution of those ingredients that impressed him. Everything was simple, but literally perfect. So after his meal, the junior chef went and spoke with the Michelin-star head chef of the restaurant, and the head chef told him that he had also gone through kind of that exact same process as him when he was younger as well, when he was starting out in his career, where he kind of found himself overcomplicating everything and trying to make these really high complex meals. But the Michelin star chef, he said that he was thankful that, he'd gone through that journey, because the complexity of his approach initially, that complexity, that gave him the knowledge that was required in order to now be able to execute the simplicity of his dishes perfectly. So the lesson here for us is that elegance and consistency, that actually comes from simplicity, that simple recipe that he now has. But to get to that level of simplicity, first you need the deep understanding, and that deep understanding that actually comes from the initial complexity. So what I'm trying to say here is that your first few initial versions of your trade plans, they might actually be quite complex. When you're writing out a lot of your process, and there'll be a lot of words and a lot of explanation, and that's fine because that can, really, really help you at the start. But eventually you will find kind of as you go along and you get more experienced and you kind of really refine your style, you will boil it down to just a few key sentences on one page. So you should end up with one very simple trade plan, and then also your full end-to-end process laid out as a separate flowchart diagram alongside that. But of course, that short, simplified trade plan, that is what you will be looking at before and during every single trading session. Now, there are a lot of things that you can include in the contents of your plan, but I would recommend that you have these 3 components as the bare minimum. So as long as you define how you will enter the market, how you will then exit your positions out of the market, and how much you will risk on those positions, then you are pretty much good to go. So the very first time you create this, make it as simple or as complex as you need to, but just get something down for all 3 of these sections, because you just need something that you can then go and test. And then once you're testing it, then you can start that process of refinement. But you just need the starting point. So, don't try and kind of perfect it straight away, because it's pretty much going to be impossible. Just make sure you get going. Now, there are, of course, other sections that you can add, such as diagrams of your entry model, screenshots of actual trade examples from your plan. You may want to list the specific trading hours that you will trade within, list the pair or pairs that you actually trade, and if you trade multiple pairs, you may have slightly different rules for each pair. And I haven't listed it here, but you can even go in a lot of detail on kind of your risk management and your risk limit rules as well. So of course this is not an exhaustive list, but just something to get you thinking about. Now in the next lesson, I will show you kind of a beginner's trading system that you can use as an example to kind of see how this could potentially all be laid out for you. Now trading is an individual sport. I can teach you the theory and I can show you how I trade, but ultimately the responsibility falls on you and no one else. It's just you who is going to be pressing buy and sell. No one's going to do that for you. You are here to become an independent and consistently profitable trader. That is going to require you to build, develop, and evolve your trading plan into something that is unique to you. Now, of course, it will still be heavily based on the core concepts, but you then need to take those and mold it into something that makes most sense to you, that suits your trading psychology, and that you can actually execute with your current lifestyle and your current routines. Trading, it's not rigid with very hard and fast rules. People make their own interpretations based on the theories and the concepts provided and trade what they believe to be right. There's a million ways to make money in the markets. Odds are that you're not going to be good at scalping, day trading, swing trading, and position trading. If you try to do them all, you will most likely end up being, a mediocre jack of all trades and a master of none. So don't spread yourself too thin at the surface level, because to truly reap the benefits of one strategy, you have to sacrifice the others. Identifying what you should focus on and specialize in is where that compounding momentum will take off. So go deep on that and specialize, because that's where your processes and your results will become more predictable, scalable, and sustainable. Style drift comes from not clearly defining your strategy and your goals. As a result, you won't stay with your approach through the thick and thin. If you are a short-term day trader, you must recognize that exiting a trade, for a quick 50 pip profit, only then to watch it go on for another 300 pips, that is of no real concern to you, because you specialize in and operate in a particular zone of an instrument's price movement. But someone else, they might operate in a totally different area of the curve, but both traders can be successful. However, if you are a longer term trader, there's going to be many times where you are running in a decent amount of profit, but only to give it all back in the pursuit of trying to capture a much larger move. But the key is to just focus on a particular style. And then once you define your style and your objectives, it will then become much easier to stick to a plan and to attain success. And then in time, you will be rewarded for your sacrifice with your own speciality. And it takes the same commitment that you would make in a relationship. How good a marriage do you think you would have if you kept cheating on your spouse? A trading strategy is the same. You need to be faithful to it for it to give back to you. Because just because we can do something doesn't mean that we should do it. So if we know that if we spread ourselves too thin up here, on the top surface level, it's very unlikely that we're going to really reap the benefits of a particular style of trading unless we dig deep down into it and specialize. So we know that digging below the surface, that is where the oil is. That is where the treasure is, and that is where the real gold lies. So when we're up on the surface and we can see all of these different ways of trading, how do we know where the oil is below? How do we know where to start drilling down to the surface? Because one way to drill would be to just start, randomly drilling all over the place and just finding out, through process of elimination where that oil is and where the gold lies. But that's going to be quite, time inefficient. And you could waste a lot of money, drilling down into all the wrong areas, right? So that begs the question, how do we work out exactly where it is that we should spend our time and where we should spend our resources drilling down into to find that oil, to find the gold that lurks deep beneath the surface? Well, there are a few steps to this. First, you need to get real with exactly who you are and where it is that you want to go. Because once we identify this, we can then move forward and determine precisely what actions you need to take to get there. And this is the time to get real with yourself so that you can map out a clear plan of action and move forward unimpeded. So there are 4 main steps to figuring that out. And the first step is to very clearly define your trading goals. So what are you trying to achieve and why? But you must also consider your current lifestyle. So what are your current time constraints and commitments? And then it's time to dig deep into your trading history and your journey so far, really looking under the hood at everything, the good, the bad, the failures, and pull out all of the lessons that you can find from here, because there will be many if you spend the time to look hard enough. Now, of course, if you are new to trading or you are new to this strategy, then you will not have a relevant trading journal just yet to go through now. So this step does not apply to you just yet. But these steps, the next 2 steps that we're going to look at, number 3 and number 4, they are for when you are refining and improving your already established trade plan. So, you will study your trade journal to try and identify the patterns and commonalities within your past trades so that you can implement rules to help you to do, more of what works and to do less of what isn't working for you. And then once you do this, you will pretty likely find that you're going to identify some psychological blockages that you may have that are actually holding you back. But once you identify those, first, you must find out exactly why you have those blockages, and then you can implement steps to help you overcome them so that they no longer hold you back and limit your growth. And now you will be able to rise to that next level. So spend some time getting very clear and honest with yourself on what you are trying to achieve and why. Because if you want to become a full-time trader, then it will most likely make sense to develop a strategy that's quite active, maybe hands-on, maybe on the intraday timeframes, because you will be able to, be at your computer screen undisturbed. But if you want to trade around your current job, or maybe even running, another business that you own or you work within, of course, this is also possible. Contrary to what Instagram might make you believe, you don't actually have to quit your 9-to-5 job to be considered a professional trader. But you must be realistic and adapt your strategy to work around your job or business. You will not be able to be on the charts and probably actively trading the same way a full-time trader can be. Now, it's very similar for if you are someone who wishes to travel and trade. You will most likely want to either develop a longer-term hands-off strategy where you are setting risk entries on the longer-term timeframes with kind of that set and forget management, or go to the complete other extreme and maybe you just want to day trade, 1 or 2 days a week, for example, where on those days you do not travel or explore that day, but you dedicate those days, that time solely to trading. So when you're thinking, about your trading goals, do not focus on that sort of end result, i.e., you want to replace your income with your trading profits. Instead, focus on the process and the lifestyle. What lifestyle do you want to live? Because it's that lifestyle and that process that is actually going to get you that result. It's very common for people to want the monetary results that successful trading can bring, but it's not so common to desire the lifestyle that result requires. Now, by lifestyle, I don't mean, what house you're going to live in and what car you're going to drive. What I mean is, what is your everyday life trading routine going to look like to achieve that result that you want each day? So start thinking about this now. Then once you have a clear idea of what your goal is and what you're trying to achieve with your trading, then you can start to plan out the steps that you need to take to get there. And a big part that is going to determine what steps you can actually take will be what your current lifestyle is. So what are your current time constraints? What commitments do you have? Do you have dependents? Do you have young kids, or maybe you care for someone? Do you have a 9 to 5 job? If so, do you have regular access to your trading charts? Think about what time frame can you actually enter on? What time frame can you manage your trades on? Is it realistic that you will be able to monitor the 1 minute chart for entries during work? You might need to drop your ego a little bit. Don't worry about trying to get a 2 pip stop, and instead build a trading system around the M15 risk entries, for example. Maybe using the M15 or even the 4 hour for entries, that could be a lot more sustainable for you, and you'll actually have better results in a quicker period of time. So maybe you just need to look at a few more pairs if you're going to be looking on those higher time frames, and that will be working better for you. And if it's just not realistic to split your focus between your job or your business, or maybe you do something that means that you don't even have access to the internet or your computer when you're working, then swing trading will probably be a lot more realistic for you, right? Focusing on those higher time frame moves. Now, another major thing to consider is what time zone do you live in? For instance, if you live in New York, and I believe you are in the Eastern time zone, then the London session starts around 3 a.m. for you. So are you going to get up early to be on the charts for 3 a.m.? How realistic is it that you can then trade the London session through the early hours of the night and still perform your job during the day and keep your health and your mental well-being intact? Because some people can do it and they feel that the sacrifice is worth it, but most can't. So figure that out and be honest with yourself and just pick what is most sustainable. And maybe you can, even look at concentrating on currency pairs that, sometimes move more during the New York session and even the Asian session. So pairs like Aussie dollar and the Japanese pairs, the Japanese yen pairs, and specialize in those. Now, if you really want to hang out on the beach and you want to travel the world, then you should probably work on swing trading or even position trading strategies, because it's not really that realistic that you're probably going to have, great Wi-Fi on the beach or by the pool, and the sand in your laptop or the sun glare on your screen. It's not really realistic that's going to affect your trading intraday, right? But if you like the excitement of facing a new trading day with a clean slate, just trading for a few hours, then day trading might be for you. Now, you might think that day trading sounds sexy, but if you have a demanding job and 2 kids, maybe it's not that realistic for you, right? But only you are going to know this, but just try to be honest with yourself now, and you'll save yourself a lot of time and headaches. You'll find quicker success, but more importantly, sustainable and scalable success. By sticking to what you can currently execute, so design your trader plan around a style that actually fits that. Obviously, then once you achieve your goal and your lifestyle changes, then you can adjust and adapt your trade plan to fit that, right? As I said, the beauty of the strategy is that it's based on price action. I've shown you the blueprint and all the tools that you need, but now it's down to you to kind of take that and tailor all of that and tailor that strategy to suit your lifestyle. Now, we'll talk about journaling a lot more in a future lesson, so we're not going to cover this in depth now, but kind of a quick point is that when you are revising and improving your trade plan, going forward, analyzing your trade journal will play a large role in this. So you will essentially be trying to look for repeat patterns and commonalities in your winning trades, and then the same, for all of your losing trades. So this way, you can work out how you can do more of what is working and less of what isn't, so that you can implement new rules into your trade plan to avoid repeating those same failings. Now, don't rush this process. It's not glamorous. It is pretty boring. I'm not going to pretend it isn't, but it is one of the single most effective things that you can do to make a quantum leap forward with your results. Because if you spend a week, a month, however long it takes you to do it properly, get it done, the lessons will be in there. Some of the biggest lessons and improvements that you can actually make with your trading will be in there. Digging through your journal, that is the work that other traders, they just simply are not doing. So if you do it, you are literally giving yourself a massive edge over them. And in that previous step, where you have reviewed your trading history, you will probably have found technical problems with the strategy, which you can make simple kind of adjustments and improve with new rules in your plan. But you will also probably find that you are making the same silly human errors again and again. So this final step, step 4, it's all about finding the why. Why are you making those same mistakes? And you need to identify your psychological blockages. And there is a lot of introspection that goes into this process. What are the main barriers that are holding you back? And then what is your plan for actually overcoming them? The more reflection, self-review, and contemplation that you perform as a trader, the quicker you will progress. For instance, when you review your journal and you kind of look through the data, you might spot that, every time you lost the first 2 trades of the day, your results then spiraled and you took a lot more losses when this happened. So Very simply, you can implement a pretty simple risk management rule to just stop trading for the day if you take 2 losses, for example. Now, this lesson is not about trading psychology. We will cover this in a lot more depth later. But for now, you just need to understand the 4-step process to go through each time you are revising, updating, and improving your trade plan. And that's how you can define your own trading personality and actually create a plan that is individually tailored to you. Because once you have that, you will massively increase the chances of you actually adhering to your strategy rules, which in turn then increases the probability of you achieving long-term consistent results. Now, in the next lesson, I'm going to show you a relatively basic trading system for you to use as an example to see how you can begin to structure your own trading plan. Okay, so here's a bit of a basic template that I've put together for you guys to download and duplicate your own copy to your Notion dashboard. So there should be a link below the video in the notes, and if you click on that, it should open this up. And then it should be like a little duplicate button somewhere around the top right where you can copy it down to your dashboard already. Unless, of course, you have downloaded the initial trading dashboard version that may actually have this already included in that part of the section. If this is here, then yeah, you don't need to worry about kind of re-downloading that and duplicating that copy, as it should be there for you already. In the next lesson, we're going to go through sort of a beginning trading system. So all of this will make a lot more sense in a bit when we actually go through that. This is really just to give this to you now before we go through that lesson. Just so you have it. So yeah, it's really, really basic, right? This is your trading plan section. This will essentially be your trading plan document where you can go in here, just put a little reference there, put whatever there, something to motivate you, whatever works for you. And then we kind of have these sections here, which, like I said, we'll go through that in the next module. But essentially, this is where you can put in your steps, and then you can essentially tick them off, and I'll do like a strike through for each time you are looking to potentially execute a trade. You've got your trade management there, your risk management. Now here we have these kind of toggle lists. So again, we'll go through this in the next lesson, but this is essentially where you can put in your sort of full process for how you map and analyze your charts each time you go on there. So obviously I've just put an example in here, but go in there and change that and do what works for you. And then we have these 2 sections here. So entry models and then basically high probability examples. So essentially all that means is this is where you can put in some kind of diagrams, or sort of, diagrams you've annotated and you've drawn that kind of explain the theory behind the setups that you're looking for. So you can, if you have multiple different models that have potentially slightly different variations, for example, maybe you trade risk entries for one setup, maybe you trade confirmation entries for another one, maybe on one confirmation entry, you put in that sort of liquidity sweep model. Another one, maybe you're happy to trade without seeing liquidity sweeps, for example, something like that. Or you may want to separate out, when you'll take a flip zone setup and when you're happy to take just a structure zone if there is no flip. So you can just kind of put in slightly different variations there if you want, or keep it simple with kind of just one general model. And then here's just when you can put in a few high probability examples. So it's just screenshots of trades that you have found that line up. Now this bit here where we're putting in kind of examples, we'll get into that in a little bit more detail when we get into the next module on testing, where you start to collect trade examples based on your plan. So obviously you won't be building this straight away, but obviously as we go through, you'll start to fill all of this out. And then whenever you see this, basically if you just click on that, it should just pre-populate another imaged box there for you to use. And I've just chucked some nice quotes down here where again you can just put in some stuff there that can potentially help with your psychology if you want to, or yeah, just get rid of this, get rid of it all, delete it all if you want, and keep it nice and simple. Another thing as well, if you hadn't kind of already realized, if you click these 3 dots up here, it does give you a bit more customization for your Notion documents. You can change the text, you can make it a little bit smaller, you can do full width, which this can be really useful when you've got images obviously a bit further down, as it can expand them nice and wide for you to see. And yeah, you can play around with that. So that's pretty much the basic trade plan. As always with anything like this, don't just take mine, always be looking for how can I improve it, how can I make it better, how can I make it into something that's unique to me. And of course, please feel free to share that in the community, as other people may benefit from what you've done and the work you've put in on that. And then if I just go back out to the trading dashboard again, the other setup that you will see in here is the other page, I should say, that you'll see in here is called setups. So this is essentially where potentially you have those multiple entry models with those slight slightly different variations or nuances to each model, you can click in here. Again, this is where you'll have that diagram. You may want to put in your kind of specific confluence that you're looking for within here, kind of bullet point that for the specific entry model, have your annotated diagram there, and then this is where you can then just basically have a collection that you will grow over time of different variations of those examples in the live market, right? Reality or realistic trade examples that are basically all based on that entry model. Of course, if you've got multiple, then you can start to build those out. So again, this is something, collecting these examples and building out different models that will come with time, especially as we start to look at testing in the next module. But yeah, that kind of just wraps it up for now. Just wanted to get these templates out to you guys within the trading plan section for you to just kind of use as a starting point. But yeah, all of this will make a lot more sense as we go through this in the next video. Enjoy. Alrighty, so let's take a look at how we can kind of build out a trade plan for the Photon strategy. Now, there are endless amounts of ways in which you can structure a trade plan. I used to years ago have about a 50-page document detailing literally every single, technical concept or rule that I had, almost kind of condensing, your entire strategy into a document. I think that's kind of unnecessary. I'm much now today lean towards just having a very, very lean one-page plan because, everything is pretty much in my head. I know it inside out, but it's just good to have a few kind of key main rules that I refer to. So if you just look at the notes below the video, kind of that first initial text is basically what my trade plan looks like. It's just a few key points. But of course, some of you are going to need a lot more than that, especially when you're starting out. So what we're going to do in this lesson is kind of go through all of the diagrams that I would recommend you kind of have in one place. And then you can kind of, from that, take that and mold that into your own of the level of detail that you think you need and require. But as we go through it, I'll kind of explain my thoughts in more depth. So the diagrams we're going to go through, you've already seen. They're all already laid out through the course. We've gone through them quite a few times in multiple different videos, but I think this kind of a good visual way to kind of try and get in your mind what it is you're trying to do. And then before we narrow down towards the end, of just almost like those written rules. Okay, so kind of the first step, I kind of call it the high level trade plan. And it's thinking about the way we view the market through multiple timeframes, right? So if you're seeing this for the diagram for the first time, you definitely go back and watch the previous videos where we covered this at the start of the liquidity module and at the start of the Photon strategy module. Okay, so essentially, you guys should know this. You have your 3 timeframes, right? Depending on whether you're sort of swing or day trading approach, you should be very comfortable with that. But really, this diagram is just to show you how the medium time frame fulfills the objective of your higher time frame, right? So in simple terms, you'll have your higher time frame being bullish, then we get a higher time frame pullback, and then we get a higher time frame continuation. Now, when that whole move is happening, the medium time frame will shift bearish to facilitate the higher time frame pullback. When the objective is complete, i.e. we pull back to higher time frame demand, the higher time frame pullback is over. What do we now expect? We expect the medium time frame to switch bullish to now target the higher time frame week high. Okay, we should all be very, very comfortable with that. So that's basically what we're playing every day. When I get to my desk, it's the medium time frame is what I'm focused on, right? That is the directional bias. So when we get that break to the downside, I always just identify what is the medium time frame range I'm playing within. Okay, I'm bearish. The objective is to play the higher time frame pullback. Therefore, I'm going to look for shorts from my medium time frame POIs. Right? That's literally the formula every single day I get to my desk. Medium time frame directional bias, know what it is within the higher time frame narrative, wait for your medium time frame POI to be mitigated, and then you drop down to your lower time frame and then look for your entry model of choice. Okay. And then obviously there's all the different areas of the market in which that can be happening. All right. When we get down into here, we probably don't want to be thinking of shorting anymore, right? When price pulls back in, because even though the medium time frame is bearish, not a great time to be doing it. Why? Because the higher time frame pullback is complete, and this is when we're expecting the medium time frame to turn bullish. Okay, that's why it's important to understand that multi-time frame analysis. And really, this is what this diagram helps you do. Okay, now, as you should also know is, okay, that's great. This is kind of simple where you've just got, a nice little M15 range here. We're looking for price to come in and we're looking for shorts. But when we think about just the medium time frame, very often this range here between the 2 red lines, this medium time frame range, right? Sometimes it can be a very large medium time frame swing range. And within that, we can have like medium time frame internal structure. And within that, we can have like the medium time frame fractal structure, right? And there can be a lot going on. So bringing your kind of understanding to the next level, that's where the medium time frame phases diagram comes in. Okay, so it can look very similar to the one before, but really the key difference here is that this is just one time frame. So everything you see is just your medium time frame here, right? So this would be where like this is your medium time frame swing range. So this is the medium time frame swing low. This is the medium time frame swing high. And within that, what do we have? We have the internal ranges, right? So this would be your internal range. And then within that, we have the fractal structure. Okay. Again, if you're seeing this for the first time, you've skipped lessons, do not do that. And make sure you go back through where we cover this in depth in the medium time frame phases lessons, but also throughout the entry models lessons as well, where we go over this, really, really in depth. Okay. But the key to nailing this strategy and having long-term success is really getting your head around these phases, building the narrative. It's not simple. It takes a little bit of time, but I promise you, if you stick at it every day, it will become second nature pretty quickly. Okay, and you'll have this literally in the back of your mind. So yeah, make sure you have these two diagrams together, put it in sort of your trade plan section in Notion or whatever you want to use. Print them off, whatever it is, and just have them available to refer to. And what would even be better is if eventually you make your own versions of the diagram and kind of put in your own key points that make sense to you. Okay. Now this is not like the golden ticket that just completely solves everything for you. Every situation in the market is going to be slightly different and unique, right? And that's just something that you'll gain with experience of like when you want to take phase A to when you want to take phase B, when you want to ignore phase B, all that stuff will come with time. Okay, but yeah, I'm not going to talk about this diagram in much more depth because we've gone through it loads, right? Then we've got the entry models. Okay, so really the first two diagrams is just helping us understand how we build that overall narrative, that overall direction, how we know our expectations of where we're expecting price to move and whether or not we want to get involved. Because just because price is in a medium time frame POI doesn't mean you should trade it. I know that seems simple, but it takes a lot of people to truly swallow that pill and truly understand it. So you get burned enough, that's when you know, okay, yes, price is in a medium time frame POI. Yes, I could probably see that price is going to go in the direction I think it will, but it doesn't mean that you need to risk your capital on that move. Okay, wait for when you have really, really high confidence in getting involved. When you do have high confidence of playing that idea, now we come into our entry models, right? So LC2A, this is really the main entry model that I use and that I would encourage you guys to focus on, and that's waiting for the fake break, right? The other entry model that I don't really personally use, but Tomas does, is LC2B, and that's basically rather than having a fake break, we just have really big obvious equals. Okay, so rather than it's a strong low that broke structure, it's just when you've got big, clear, obvious equals, that can sometimes be good, strong liquidity, right? It's kind of like a support floor inducing sell side liquidity below. So you may want to add in LC2B to your trade plan if you want to. I might use it once or twice in a year. I'll use a little bit of discretion to use some equals if it's in a really high probable scenario. But without sounding egotistical, like I've kind of earned the right to do that. I have a lot of experience. I used to trade that entry model, so it's something I'll potentially use in rare scenarios, but what I recommend, especially if you're new, is you don't need it. Just focus on LC2A. It's 100% mechanical. There's no discretion about are they equals, are they not? Like just focus on this, okay? So yeah, not going to go into all the rules. You guys should be very comfortable with it. And then of course we have LC1 as well. This is definitely a bit more advanced because it's a lot more aggressive. So yeah, the rules are here. Again, you guys should know this, be comfortable with it. But because LC1 is a bit more aggressive, we have kind of this other diagram, which really it's just a copy of the phases, but it's just to go into even more depth, specifically thinking about LC1 here. Right, I've done a whole lesson on this, so make sure you go back and review those lessons. These lessons where we go through these diagrams, talking about the phases, talking about what's higher probable and what's sort of lower probable. They're the lessons you want to be watching almost every week, every month. Just keep going over them, because as you get more experience in the market, you will then come back to these lessons and you'll have that new level of awareness, and you'll take on board things that you missed before, because there's a lot of information to take in. So yeah, that's kind of, just keep revisiting them. But yeah, these are kind of like the recommendations of when to think about LC1 if you're struggling with it and finding you're taking a lot of unnecessary losses with it, okay? And then this is kind of where you get sort of more of a classic trade plan, right? Of writing down, a bit of text. Now you can have less than this, you can have more than this. This is kind of just I thought might be useful for you guys to kind of have as a good starting point. Okay, but these are just suggestions. Modify the rules as you see fit. Like, this is an example trade plan. Okay, turn it into your own living and breathing document that you're always improving and working on and building. Okay, so excuse me. So we have the mapping process on the left hand side, and this is really just what you do when you come to a blank chart. Like, some of you, again, you might not think that you need to have this written down. It's fine. Like, I don't personally, but yeah, it's here. So go on your higher time frame. And again, like, I use multiple time frames, right? I use the daily and the 4 hours as my higher time frames. I have more than one, but if you find it confusing, just stick with the 3 time frames. Always map your structure first. So do your swing, then your internal, put on your premium and discount. Okay, you should be very comfortable with that. Map the relevant supply and demand zones. So just, map the ones that are within those current structural ranges, and then maybe like 1 or 2 just outside the range. Okay, but you don't need to map every single supply and demand zone you see in your entire chart. Just keep it to the current range that you're working within. Okay, keep your eyes focused on that. Map any relevant, liquidity sweeps, like was there a sweep zone, etc., and any sort of available liquidity pools, like are there some nice equals that are probably going to be targeted, things like that. And then, yeah, you can just set your alerts on those high time frame POIs and key levels. Like, when is there going to be a high time frame break of structure? Perhaps you want to put your alert there. It doesn't really matter though. Medium time frame, again, just do the same process. Just map your swing structure, map your internal premium and discount, map the relevant supply and demand zones within those ranges or nearby. Map your liquidation points, and yeah, just set your alerts at those POIs. Wait for price to come in, so you're not just trading in no man's land, right? We know that we need to have that medium time frame POI mitigation before we get involved, and then obviously once we do get that, we're not just trading every single medium time frame POI. We're trading ones that are relevant, where we are expecting tradable reactions from. That's then when we drop down and we do our lower time frame execution. Wait for the mitigation, trade your entry model, follow your management plan. Okay. Now there's a bit more sort of, I guess, information on POI selection here. Obviously, there's a bit of an art to this, but obviously minimum criteria for a supply and demand zone is that it at least breaks some form of structure. And then we have added confluence. Is it a flip? Is it a sweep zone, right? Did it sweep liquidity when the zone was formed? Is there available strong liquidity in front of it? So is there lid to the left, or is there that fake break built to the right? Now, you don't actually really need to kind of ask yourself that, because this is really baked into the entry models, right? We either need lid to the left, which is LC1, or we need to wait for the fake break to the right. So no matter what, if you're following our entry model rules, there will be available strong liquidity, because they are a strict requirement of the entry models, right? So, but I just put it there anyway. Another added confluence is your medium time frame POI stacked with a higher time frame zone? So i.e. is an M15 zone nested within a 4 hour zone? That's obviously going to increase the probability. Is it well priced? Is it well priced within the swing range? Is it well priced within the internal range? Then we know that adds a bit of confluence. Ideally, we want to be trading from completely unmitigated zones. Is it part of a supply and demand chain, right? Seeing those series of mitigations. Now, there's some questions here that can kind of just help you to build a narrative and really kind of, take your time and start to. This is an art, right? This is stuff that I can do in my mind in about 2 or 3 seconds, because I can just visually see it. I have years of experience, countless hours, 10 hours on the charts every day just staring at price action. I almost do all subconsciously. Like, I can just stare at a zone and within a few seconds I know if it's a POI I want to trade from. When you're starting out, that's obviously a bit harder to do. So these are just some questions that can help you, right? I'm not going to go through all of them. They should be reasonably self-explanatory if you've taken the time to watch the course in order, but this can maybe help you. But really, all of these questions is baked into all of this stuff, right? So if you can understand these diagrams and how we build a narrative and how we go through it, it's just another way that's going to help you make sense of it. Okay, but again, if you do get confused with all of it and it's just information overload, just remember, what are we trying to do? We're trying to trade medium time frame POIs with lower time frame entries. If you can understand the lower time frame entry model, and if you can understand how to identify a medium time frame POI, you're halfway there. Okay, obviously we don't want to trade every medium time frame POI, but if you can get your directional bias correct, you're bullish or bearish for the session, you've identified a decent well-priced zone, wait for price to come in, hit the entry model. Okay, just get experience with that. Then you start over time doing your journaling, doing your markups, and you'll quickly build that experience of, okay, actually you'll then realize it's more about when not to take a trade than when to take a trade. Because once you've learned the rules, they're pretty easy to learn. You'll be able to identify trades all the time, especially every session if you trade the M5. But what will really get your results there is when you realize when not to take the trade. That's when you kind of start reaching that profitable consistency. Anyway, so that's POI selection, narrative building, kind of a way in which I could summarize that for you guys. And then, the lower time frame execution, obviously you have the detailed rules in the entry model diagrams. But this is kind of just the way I could summarize it up if you need like a rhyme in your head. It's like wait for the mitigation, liquidation, validation, and then you place the entry. So mitigation, obviously wait for your medium time frame POI to be hit first. We know that's a strict criteria. That's literally the first thing we need to wait for. I've just put HP for like, high probability, medium to high probability. We want to be trading decent ideas. Liquidation. All right, so we've got our mitigation, but obviously we need to have that strong liquidation. So either identify if one has already occurred, or if there isn't one, then we just need to wait for one to form within the POI, right? Very simple. So what's the strong liquidation we look for? We either look for the fake break in the pullback. That's the first thing I'm always looking for and what I prefer. And if it's a scenario in which you're happy to use LC1, right, where we use that strong liquidation in the MTF leg to the left, right, where we can look for lid. Now, I personally am happy to use lower time frame lid from that medium time frame leg to the left, right? So again, where are we? LC1. So it must be, I'm looking in the medium time frame leg to the left, right? And if there is a lower time frame low here, I'm happy to use that. Some of you might want to use a rule that it must be visible on your medium time frame too, because technically that should be higher probability because it's more significant. Okay, so again, I'm personally happy to use lower time frame lid within the medium time frame leg, but some of you might want to say that it has to be visible on the medium time frame. So if you're struggling with LC1 and you want a higher strike rate, I would put that rule in that for you, the lid must be visible on the medium time frame, okay? So once we have our mitigation, we've identified there's a strong liquidation, then the next question is that strong liquidation still valid, right? Is it still relevant for the POI I'm trading? Because sometimes it's really far away and you're not sure. Well, this is where you can use one of the two methods, the PBL method or the early entry method, right? The two lessons for those are in the LC2A module. So make sure you go back and watch those if you don't know what I'm talking about, okay? But you don't need to use these methods. And also, sorry, I should say pick one. Obviously, don't use both, like pick one and stick to it. And some of you might not want to use it. Like personally, I'm going to use discretion because these are just a rule that we try to think, what could we give you guys as a mechanical rule to help you when you're starting out? I'm personally very happy to use discretion here. If I get a strong liquidation and it's in a high probable POI, I just want to get involved. The entry model for me is a timing mechanism for my medium time frame idea. I have very high confidence in my ability to identify, good medium time frame ideas and good medium time frame POIs. Therefore, I'm not so bothered about this personally, okay? But for some of you, it can be a really good strict rule to use just to help you kind of remove as much discretion as possible until you feel comfortable with that, okay? And then obviously, you don't really need to write this in, but I know some people like it. But obviously, once you've got all of those rules, so you've got the mitigation, we've got the strong liquidation. Yes, we validated it, it's still relevant. Obviously, wait for that first candle to close, the liquidation candle on whatever time frame you're using. For me, it's the M5. And obviously, place your stop order entry in front of the candle. So if you're buying, place it above the candle. If you're selling, place it below the candle when it's closed. Now, if price keeps moving within the POI and it doesn't tag you in, obviously we cancel our order and we wait for the next candle to close. If you don't know what I'm talking about, make sure you go back and study the entry model lessons because it's covered in there, right? And we keep trailing our orders with those new candles until we're either tagged into the position or if the POI fails. The very second that price trades through that POI, so just a wick break, that POI has now failed and now the trade idea is no longer valid, okay? So you must now wait for a new medium time frame POI to be created and then mitigated, right? So really, you can literally just put mitigation, liquidation, validation, and that's essentially the entry model. Trade management, again, trade management is so individual to the trader. You can do whatever you want. We recommend just using, when you're starting out, to get consistent, set and forget, fixed R. It makes it simple. It makes your backtesting consistent. Removes all the discretion. It's really easy in the psychology, or much easier, when you're starting out. Use the backtesting spreadsheet to help you find the most optimal target for you. Tamas likes to use 2R at the time of recording. I like to use 3R at the time of recording. It's completely up to you, okay? Now, I personally will be using discretion to target bigger targets when price is in a high probable scenario. So again, this is going to require experience, but I'm willing to use that. So it's up to you how you want to do that. So I won't be, at least at the time of recording, I'm not using any stop loss trailing method. I'm not taking any partials. It is set and forget. Now, that might change in the future, I don't know, but this is just an example of kind of how I have my plan set up at the moment. So again, some of you might want to do it differently. Some of you might want to remove your risk. When you have certain criteria, you might want to use partials, you might want to use bigger targets. You might want to do counter trend 3R, pro trend 10R, whatever it is. The world is your oyster, right? But at the start, keep it simple, set and forget 3R, get your consistency, earn the right to use more discretion and bigger targets, and go from there. And then risk management. This is super, super serious, okay? 3 losses per day. Some of you might want to have 2 losses per day. There's actually a rule I haven't added in here that you might want to consider, which is, maximum number of trades you want to be in. Like if you trade multiple pairs, you might only want to take, 2 trades at any one time. Put in whatever risk you want, 0.5, 1%, whatever. I wouldn't really go above 1% in my opinion. It sounds great when you put it into a compounding calculator, but when you're trading serious capital and you hit your inevitable drawdown period, that's when your psychology will really be tested. So I'm personally happy to optimize for smaller drawdowns, and I don't need to say too much more on that. 2 pip stop loss as a minimum rule. I'll never go below that. Put the pairs that you trade, no entries, let's say 30 minutes before pre-high impact news. Again, these are just suggestions, right? This is not like the most perfect rule. All of you are going to have different levels of risk tolerance. A good rule of thumb can be like, if you're not sure which news events to avoid, I always say like any rate announcements and like CPI, US CPI, and like NFP, those big ones, FOMC, etc. But like if you're not sure, just go on to say like the FTMO restricted news events, and that can kind of help you to see what's worth avoiding and not. But again, it's all going to be different to the individual trader, your risk tolerance, what time frames you trade, all that stuff. Sessions, again, I don't want to get a million questions about this like I always do. They are completely down to you. Trade when you can trade, right? And just backtest, find out what hours are for you. Like you've seen the LC data I've shared. I took all trades between like 7 and 4 p.m. But just do what works for you, okay? Don't overthink this. We know the bulk of the volume is going to be in the first couple of hours of London. The bulk of the volume is going to be in those first few hours of New York, sort of 1, 2 p.m. These are UK times, by the way. And just go from there, right? Don't overthink this too much, okay? So look, there's so many different ways you can make this trade plan. I've given you, some visual diagrams. I've given you kind of strict text. The main thing I would say is just like, you need to be very, very strict on like, it's got to be a medium time frame POI. You've got to be strict on what your entry model rules are and be strict on your management. And then all this other stuff here, like mapping process, POI selection, it's up to you how in depth you want to have that in your plan, right? But I would definitely recommend like having some of these diagrams. Definitely have the entry model diagrams within there. Use the Notion templates that we have. And I would add in trade examples for each entry model. So when you're sitting at your desk, you can quickly open up your Notion and go, right, bang, there's the annotated diagram, and then bang, here's 10 real examples of what they look like. And you can just train your mind before the session even starts of, right, visualize, okay, this is what I need to look for. This is what a good trade idea looks like. And then that way it can really help you to give you confidence of when you are in the market. So I hope that's useful. But like I said, you need to take ownership of this, take 100% self-accountability, and turn this into what works for you and what makes sense. If any of you guys make any cool trade plans, or you make flow diagrams or whatever, please feel free to share those in the community and provide some value back from everyone else, and feed off of each other's ideas. Now, journaling is pretty simply just a process of recording and reviewing your trades. Now, make sure you're not digging your head into the sand, because I've given up being shocked at how many traders I chat with that do not track their edge meticulously. Not journaling your trades is pretty much the first sign of a punter who's just aimlessly charting every weekend. Because the sad reality is that there are very few traders who actually know the truth about their own trading. People don't want to know the stats. They just want to gamble, and they just want to win big. But there is a deep psychological reason that most people won't collect performance metrics. Because people want to believe just based on faith, and to not actually be confronted with cold, hard facts. They don't analyze and review the trades that they have taken just because they want to disassociate themselves to avoid the pain of their losses. But reviewing your losses, particularly early on in your journey, that is where the growth lies. And that's generally where the easiest and the biggest gaps for improvement are, where you can kind of make those big quantum leaps forward. As professional traders, we are seeking constant evolution and progression, and this process will help to make sure that we are on that path and that we're not just stagnating or worse, even going backwards. Digging through your journal is the work that other traders, they're just not doing. So if you do it, you are automatically giving yourself a massive edge over them, over the rest of your competition in what is ultimately a zero-sum game. You should constantly confront your performance head on, and that starts with the post-analysis of your results, because as the famous saying in business goes, what gets measured gets managed. The most valuable information about your trading is your trading. So again, journaling is the process of recording and reviewing your trades. And really, there are two main aspects to journaling. So there's the quantitative side and then the qualitative side. So the quantitative process of journaling your trades is just essentially being the accountant for your trading business. So you are crunching the numbers, tracking your P&L, your strike rate, the size of your average loss and your average winner, your profit expectancy, and there's just those sort of key numerical metrics like that, right? So generally, you would download your trading account statement from your broker, and you would record all of your trading data in a spreadsheet application, like Microsoft Excel or Google Sheets, for example. And there are also some automated softwares that can do this for you too. Now, this is a great start if you're doing this already, but a lot of people do not take their journaling any further than this step. And the problem with that is when you kind of get all of these numbers, spat out, the data, it very rarely paints the full picture of what is actually going on with your trading. Because imagine that your spreadsheet trade journal, let's say that it's telling you that one of your setups is performing really poorly, right? Well, after a certain point, if it continues to show poor numbers in the journal, the obvious and the logical thing to do would surely be to stop executing that strategy altogether, right? Or, at least pause it until you figure out, how you can improve it first. But unless you actually look at your trades, you don't really know the full picture, because maybe it's just you that's actually underperforming the actual strategy, because maybe you've made mistakes executing it, or maybe you've just missed a lot of setups that were winners that week or that month that actually would have made the strategy perform really well. But if that's the case, again, that's okay, because you can actually take some confidence from that, because you've now figured out the issue that, actually your strategy does work, but you just need to make a few little tweaks to make sure that you are executing correctly, and then the results will follow. So you need to be measuring your own personal performance discrepancy against the actual strategy performance. And by looking at that gap, at that difference between your performance and the actual strategy performance, that is where you figure out how to improve, and that is where the refinement comes in. So in order to fully understand the story behind the numbers that the spreadsheet spits out at you, you need to actually look at your trades and really deep dive into that and try and identify what is going on behind those numbers. So this is what we call the qualitative analysis, which essentially is just where you're taking more of a descriptive approach, to dig deep into your trades, and you're looking for any common patterns that keep occurring again and again. So you'll store the screenshots of all of your trades after you have executed them, or you can take screenshots just before you're executing them as well if you wish to do so. But then afterwards, you will write down and you will describe the different elements of your trade. So of course, both the higher time frame analysis, the medium time frame, and then your lower time frame execution. Obviously, the reasons why you took the trade, how you entered it, where you placed your stop loss, how you managed it, right? Everything that's involved in the actual execution and management of the trade. But you were looking for ways that you could improve the trade, or identifying where potentially you have made some mistakes, and then just noting any of the key lessons that you took away from that specific trade once you've reviewed it. Now, what you can also do is you can track your emotions when you were executing the trade and during the trade when you were managing it, right? So when you're in the trade, you can write all of these emotions out, what you were feeling, maybe if you felt the urge to cut the trade early, or maybe if you did cut the trade early, write in why you did it and the emotions that you felt. And then when you look back over your trades, this will really give you an amazing insight into actually how your emotions may be affecting your edge and your overall performance. Because once you do that, that's when you can then go back in and objectively see what is happening, from your emotions getting involved, and then you can start to implement some, practical solutions to try and help you prevent your self-sabotage in the future. But really, you can only do that if you do the work and you start tracking that, now as you're trading and as you're going along. So the qualitative side, it definitely takes a bit more work because it's all about self-review. And this is really, it's about looking at your trades, your trading routine, but very importantly, it's about keeping yourself honest. You have to be ruthlessly and explicitly honest with yourself, which in reality, most people find this really, really hard to do. But it's how you get that rapid growth. Now, I've built you a trade journal, for your trading dashboards on Notion that incorporates both the quantitative and the qualitative side of your journaling. So you have that all in one solution, in one place, just to kind of try and make it as seamless as possible. Because remember, this entire time, right, we understand the process side of our business is extremely important, but we need to try and kind of adhere to that as much as possible by trying to make that work feel like play, right? Now, we'll go through those processes in the next lesson, and I'll show you exactly how to use it and how to perform your journaling process. But something to consider when you are journaling and reviewing your trades is that any trade will generally always fall into one of these 4 scenarios. Now, the first scenario is a trade that is a valid trade. It meets all of your trading plan rules, and it is also a winning trade. These are obviously great trades. Now, once you have journaled these trades, following your usual process, which we'll take a look at in the next lesson, I would also save a copy of that trade review in another folder, maybe in your trade plan section, right, on your Notion dashboard. If you have a look on there, there will be a folder underneath called setups. And what you can do is you can put tons of examples in there of your high probability winning trades that are obviously valid with your trade plan rules. So these are the trades that you want to be constantly looking at and just burning them into your subconscious of what an ideal setup actually looks like. And you want to be looking at these, before, during, and after every single trading session. So you're just constantly looking at them. Now, the second scenario is where you take a valid trade, but it just happens to be a losing trade. So this is a trade that meets all of your minimum criteria on your plan, but it just didn't work out because of the probabilistic nature of trading. So these are the losses that you want to celebrate because you are executing and analyzing with consistency. So as long as you continue to do that, you will be one step closer to your next run of profitable trades. Now, the third scenario, this is when you take a trade that does not meet all of the minimum criteria of your plan, but it happens to work out and it's a winning trade. Now, you need to be super, super, super careful of these because most of the time, these are usually trades that are not within your plan, but you just happen to get lucky. Now, of course, if you start to notice this particular setup play out a lot, that at the moment it doesn't currently meet your rules, then you may now have developed a new edge. So of course, then you can build a new sort of plan around that and then go and test that new plan to actually see if it holds up over a large sample size of trades. But for the most part, you must be explicitly honest with yourself here, because when you realize that if you took a winning trade but it wasn't actually valid, you just got lucky. And luck is not how you remain consistently profitable in trading. Now, the fourth type of trade are those which are not valid and they don't work. So these, in my opinion, are kind of the only trades that you should really try to learn from on the losing side. They can be sometimes quite hard to differentiate from the second type of trade, where it was a losing trade, but it was actually valid. So this is where you need to have those really clear rules in your trade plan. And these trades, these fourth type of trades, they are usually a result of a fundamental problem in your analysis or your execution. So when you analyze a trade, you will usually see that it doesn't meet all of the criteria of your trade plan, or maybe you managed it wrong or anything like that, where you didn't perfectly perform all of the rules within your plan. Okay, so they are the 4 types of trades that every trade you take will fit under, but just make sure that you have a section in your journal that states whether a trade is actually valid or not. And this will really help you to see what potentially may be affecting your results and which trades you really need to dig into, to look for reasons potentially why you took that loss there. Or maybe it's just a trade that falls into the second category, where it was a loss, but it actually was valid, and then you don't need to worry about over-analyzing it to potentially try and figure out where you went wrong, because this is just where the probabilities of your edge are playing out. Now, before we look at the steps of the journaling process in depth in the next lesson, I just want to end this lesson by discussing the topic of how to measure your progression. Now, there are countless ways to measure the performance of a trader, and the most sort of obvious metrics to judge our performance by are our profit and loss and our drawdown. Now, these metrics are often expressed against a period of time. People will often say, oh, I made 10R this month, or I had a 5R drawdown last month. They're all pretty common phrases, right? And there's absolutely nothing inherently wrong with that. Expressing performance metrics per period of time, that does give us a better understanding of how past performance came to existence and it helps to estimate future performance. However, the timeframes over which performance is measured and expressed varies greatly. A major difference can be seen in how investors measure their performance and how traders measure their performance. Now, in the world of investing, the focus is generally always on long-term growth and returns, and most of those types of funds, they will only focus on the year-on-year or even 5-year performance, because their approach to the market is long-term and they do not engage in day trading. So the pace of their activities and the pace at which the market moves suggests that the most reliable measurement is at least a minimum of a 1-year time frame. Now, on the other side of the spectrum, there is the day trader, who's obviously focused on short-term gains but long-term compound growth. So a day trader wishes to know how they perform on a monthly or even sometimes a weekly basis due to the fast-paced nature of the trading style. Now, naturally, the majority of us here in Photon, we will be monitoring our trading performance on a monthly basis. Now, the reasons for this are quite simple. Our trading style, it allows us to make significant monthly gains and therefore allows for the monthly measurement of performance. Now, I'm just going to replace the words investment funds and traders with business and employee, because you may be, or maybe even aspire to be, a full-time trader, and you will need a monthly form of income to live off. We are programmed to translate income to monthly payments because of our financial obligations and also the salaried employee mindset. And that employee mindset, it just forces you to think in monthly cycles, and it really gives you that short-term horizon. But you need to develop a trader's mindset, which is essentially a business mindset, which thinks in and reports in quarterly and annual cycles, and they are fixated on the long-term horizons. So measuring and expressing your trade performance per month, it can give the wrong impression of your true long-term performance. That's why hedge funds and investment firms, they will rarely publish monthly results, because their focus is on quarterly, 6-month and annual results. The reason for this is that monthly performance is just simply not relevant if you're in it for the long run. Just like the trade-by-trade reaction, our month-to-month performance, it can really dictate a huge part of our emotional state. Individual monthly results, they can be an inaccurate representation of your true long-term performance. Now, I measure my results on a monthly basis, but I only evaluate my results every quarter. So that means that my focus is on the quarterly results and the big picture, instead of monthly performance swings, which market conditions and simple probabilities, they play much more of a role in when you're looking at your results on that time frame. So here's a quick little thought exercise that I'd like you to try for a second. Now think about, let's say you were testing a strategy to see how well it performs, and you only tested the strategy on just 1 month of data across, let's say, 5 trades. Would you then use that data to make any sort of judgment or base any decision on that in terms of how the strategy performs? No, of course you wouldn't, because it's nowhere near a big enough sample size of data to draw anything near a statistically significant conclusion from. So don't do the same from your own individual monthly results. Zoom out. And even measuring your performance on a quarterly basis, that can still be pretty, short-sighted, but it will help to remove any emotional involvement and distress on those shorter-term swings. Just remember, if you are in it for the long run, then why would you get emotionally involved with short-term results? It's just irrational. Now, if you do happen to get a negative return for a quarter, then generally there are only really 3 things that can be happening. You're either breaking your rules and you're not sticking religiously to your tried and tested and proven trade plan, or potentially you may have missed way too many trades, so you're not seeing your true edge play out because you've missed some winners that should be part of your probability model, or the only other final option is that you just simply do not yet understand your strategy. So this is why we perform qualitative analysis when we journal and when we review everything after each quarter to see which one of these 3 areas is causing the issue or has the biggest room for improvement. Now, if you can isolate which of these elements is the issue, you will see the biggest improvement in your long-term performance. I can absolutely guarantee you that. Once you find the root cause of any issue, only then can you begin to put the right solutions in place. So this is why in-depth journaling is really vital to your ongoing success. Obviously, the bigger the sample size of data you review, the more significant the conclusions that you can draw from it. So when you record and review an individual trade, A lot of traders will take the outcome of that individual trade into their decision-making process. They'll take that over into the next few trades that they take. And this is a textbook example of recency bias. So let's say that you review a trade and you see that if you had managed it slightly differently, you could have made an extra 5R. But then what a lot of traders do is then they go into their next trade and they try to manage it that way, right, in their next trade, instead of sticking to their management rules that they have actually tested over a larger sample size of trades. So if you kind of, learn something from a previous trade, but then you instantly and straight away, adapt your rules to fit that last trade, and then you bring that into the management of your next trade, over the long run, that's just going to be a recipe for disaster. Because remember, the outcome on an individual trade, it's irrelevant. We are working with a random distribution model. So, watch the Trading in Edge module if you need a refresher on probabilities in trading. Now, at the weekly level, when you review the entire previous week, you are simply looking to see if you made any mistakes by not following your plan to the T, and also looking to see if you missed any trades that actually are a part of your plan. Because only when you start to get to that monthly level of reviewing and higher, then can you begin to look for any patterns that may be forming. So these patterns could be psychological errors that you were making, potentially such as not executing trades, or maybe you keep cutting trades too early, for example, or things like that. Or they could be patterns in the actual strategy that actually maybe you have followed your plan perfectly, but let's say that you notice that you got stopped out of a lot more trades, maybe just by a few pips, before it then actually reverses and it moves back in your favor. Then you know that your just stop seems to be a little bit too tight. So now you have something to dig deeper into and figure out if your plan may actually need adjusting, as this seems to be something that is happening quite a few times. But it's really kind of only when you get to the quarterly level, when you review your previous quarter, that is where you can start to make serious considerations if your trade plan needs adjusting and tweaking, because now you have a much more significant sample size of data, over 3 months to draw conclusions from. Now, when you perform your annual review at the end of the year, this is where you can make the biggest improvements in your strategy and also your own human performance and adherence to your plan. And it will be much easier to isolate and identify what's holding you back, what psychological blockages you may have, or potentially what glaringly obvious part of your strategy can be improved. Then you can devise a clear plan of action on how to overcome it. You only get better in this game by one way, and that one way is self-analysis. Reviewing everything that you do at each level. What am I doing well? What am I doing badly? What are my major weaknesses? What are the specific steps that I can take to become a better trader? You have to persevere in a way that is conducive to you improving as a trader, not just simply doing the same thing all the time. Almost nothing in the real world is linear, and that includes trading. If you are an ambitious person, and if you have a growth mindset, you are seeking that constant progression, that constant growth, and that constant evolution, then measuring your progression with trading results, it can be a bit tricky. Here's why. Let's say that you've been working really hard and putting in the work for a long time, and then you've just had your biggest ever monthly result. Happy days. You are seeing your hard work and your progression naturally paying off. But then the next month is slightly slower. Maybe there are not really that many great opportunities in the market, but there are a lot of average opportunities that can catch you out and really start to bring your results down, over a long period of time if you are kind of still consistently taking those, rubbish setups when you should be cutting them out. Now this affects a lot of traders, and it used to catch me out all of the time, because the mindset of having your biggest month ever is that you want to constantly feel that growth and that evolution, right? But if you still have that employee mindset, if that month-to-month P&L, then that is how you're going to measure your improvement. You're going to have a negative emotional effect when you've just come off your biggest month, and then there's not a lot of opportunities to take the next month. And the mindset behind that is that you're probably going to start taking trades that you shouldn't, because you want to beat that previous month, to prove to yourself that you are constantly evolving, that you are actually getting better and better. Human intuition is to measure your improvement and growth by the physical results. So with trading, that is typically just focusing on your P&L, right? So it's the mindset and the psychology of, how do you deal with the fact that you are constantly improving, but yet it doesn't necessarily directly reflect in your P&L. If you measure your progress when you are learning purely from your P&L, it is going to incentivize you probably to take unnecessary risks in order to try and beat that previous month, to prove to yourself and probably to prove to others that you are making progression. But this is the hamster wheel of the break-even dance. So try not to fall into that trap. Because I know how it is. You've got your friends and your family, they know that you're trading, and I'll ask you questions like, well, how much did you make this month then? And it can be really frustrating at times because they just don't understand it. And to be fair to them, it's not their fault, because profit and loss seems to be pretty much the most obvious metric to measure progression by, right? But we know that it's not really that simple, and it's not fair for you to be judged on that either. Why? Because it's just simply not an accurate measure of your progression, especially in the short and even the medium term, because we're dealing with the random environment of the market. So just because you are getting better, your mindset is getting better, your technical analysis is getting better, but you just haven't finished this month with as much profit as last month, then it's all about the mindset of that is not how you measure your progression. You have to be looking at the momentum you are getting. Keep that going. You have to reflect on how far you have come since last month, over the years, and keep that as your fuel, and keep that as your fire. Because you can be constantly improving month on month, but that doesn't necessarily mean that trading the market will allow you to see you directly reflect that on how much money or maybe how much percentage you are making. And that is not how you should be measuring it. Most things in life, you can consistently improve your skill set each month, but it won't necessarily be reflected in your performance, but that does not mean that you are not getting better. So this is why we focus on process-based goals and not outcome-based goals, especially in the short term. All right, so we're now going to look at the more practical side of the journaling process. Now, I've tried to kind of slimline this process as much as possible for you guys, combining both the qualitative and the quantitative side of your analysis, kind of into sort of a streamlined, one fit size all solution, if that is the correct phrase. I don't know. Anyway, on your dashboard, here's your trade journal, right? Now, before we dive into there, you will see this, and this is just an opportunity for, if you are someone who does use an Excel spreadsheet or maybe a Google Sheet, you can link your database into here and have that as a quick access if you want to. Otherwise, you can just delete this. But the bit that I'm going to bring you to is this trade journal section here. So in here, basically you'll see the pre-populated journal here for whatever year you're in. You can obviously just change the date. Now, whenever you want to create a new one, obviously just click into here and this will generate a new trade journal for you. Now, I'm going to show you what the journal looks like in a second. But if you want to, I'll show you. When I click into here, right, if you want to edit this and obviously mold this into your own and make any adjustments, don't make it to the one that I've already made for you. I'll show you why, because basically the one that you want to edit is the template within here, right? That's the one you want to change, because then when you go to click this every time, then you're going to have your saved changes in there. Whereas if you just change this one, it's only going to be, in here, right? So if you want to make changes, again, click in here, click the settings button, and then open this template. And that is where you can kind of customize your own one. And then in the future, whenever you click this button up here, that will generate a new trade journal for you. So going into the actual trade journal, we're going to look at the reviews in a second, but basically you have kind of two main options available to you. One is using sort of more of a spreadsheet approach, and one is using a calendar approach. So if we open up the spreadsheet, this is basically the exact same one from the backtesting and the case studies example. So you guys should know how to use this. So I won't talk you through this, other than obviously when you come down here, there's a slightly different template that you can use for here. Really the only difference compared to this template, compared to the one in your case studies and backtesting, is you have your psychology journal here. So in here, you can just keep a track of any psychological thoughts you had during a trade, right? Perhaps, you might have wanted to cancel an order, you might have wanted an exit early, whether you felt, FOMO going into the trade, anything like that. This is a key area to keep track of that with your trades. So that's kind of only the real key difference. I've tried not to kind of over customize the columns in the spreadsheet too much, because I really want you guys to take ownership of this and add in the relevant, metrics that you want to track. But I'll kind of just leave this here as a decent starting point for you guys. So that's kind of if you want to use a spreadsheet or a table. Now, another way you can do it is essentially using a calendar view here, where you will add in trades each day as you take them, kind of as their own separate pages. And it's kind of a useful way to sort of visualize and organize your trade journal too. So the way the calendar works, it's pretty simple. It's pretty self-explanatory. Is let's say, you can see the trades here, right? But let's say we want to add another trade that you took on the 7th, for example. You just click the trade template here, and it will populate it for you. Now, up the top, you can just use a format such as the pair that you traded and potentially the direction, something pretty simple like that. Then you've got the date. You can obviously add the time as well. I'm just doing this pretty quickly just for the sake of this video. And let's just say it was a 10-hour trade. Now, what you may want to populate in here is the sort of essentially your trade plan, right? Your checklist. You may have it separated into your minimum criteria, right? So all of these, you'd obviously put it there, and you can tick these along as you're reviewing the trade to make sure that you, essentially have, it's a valid trade, right? You've ticked every bit of minimum criteria that you need for that to be a valid trade. Then you may have additional things in here such as inducement or whatever for you is not minimum. Just realized I got a spelling mistake there. Doesn't have to be a minimum criteria for the trade to be valid, but obviously it's nice to try and have these technical confluences to improve or increase the probability of your trade, right? So you can add these in here. Now, obviously, if you tick all of your minimum criteria, then it's a valid trade, and you can click yes. Otherwise, obviously, no. So yeah, make sure you just kind of copy and paste that in from your actual trade plan, or make a kind of shorter version of this here. Simply for the purposes of this journaling, and then you've got your higher time frame, medium time frame, and lower time frame screenshots there that you can put in, and of course any type up any sort of your text version of your notes as well. Writing up your full trade review here. Obviously your management, then your psychology journal as we just spoke about, and then kind of your key lessons from that trade, right? What could you have done better? Did you make any mistakes? Potentially any observations that you're making on this trade that you might need to keep an eye out on if those things keep repeating. In terms of maybe you're cutting the trades too short, maybe you need to change your management plan so you can kind of get more profit out of these positions, things like that, right? And yeah, and that's pretty much it. And then obviously if it was a win, right, you can just be a little bit more extra if you want and put a nice little tick there, and then you can quickly see at a visual glance where your wins and your losses and your break evens are, or whatever. And that's kind of just a quick nice way to keep a track of your journal. And obviously as you get to the end of the week, then you can add your weekly review where you can just put your total weekly R, and then again you can just write in here your key lessons for the week, kind of just your how did the week go, whether you're making mistakes, any sort of just high level overview of things that you want to be keeping an eye out on going into the next month. Because then when you complete your month, so for instance, let's say we're in October now, you complete this for the whole of October, and then you have your 4 weekly reviews here. Then your next step at the end of the month is to go and do your monthly review, right? So you would go into your October review here. Now, before you go into there, what you would do is you would copy all of the key lessons from your weekly reviews, and you can essentially paste them into here. You might want to just chuck them down the bottom, and then you want to fill out these statistics. Okay, so your total wins, total losing trades, total break-even trades. Obviously, you've got your total trades there, your strike rate, your net P&L, and then potentially if you have your entries kind of, again, I don't want to over customize this for you guys, but you might have it separated into different entry models on the lower time frames, or maybe you categorize your trades by kind of whether it's you're playing the 4-hour continuation or if you're playing a 4-hour pullback, right? I'm not going to try and kind of put words in your mouth here, because all of you are going to have slightly different trade plans, but this is kind of just to give you a rough example of if you do kind of categorize your trades into different, categories, this is kind of an area in which you can do that, and you can record the actual performance for, within each of those categories there. And then you can have a total R as well for potentially invalid trades you have taken that actually weren't not a part of your plan. And that way you can kind of see what your true strategy performance should be. You can kind of comparing that to your actual performance. And then it's just some very kind of simple questions here to answer. So actually this would be a good section where you can copy and paste those key lessons from your weekly review. You can chuck them all into here. Then you can look at, okay, what are the main barriers that have been holding you back that month, right? So you need to really be honest here, really take the time to kind of reflect on how the month has gone. What are the main barriers that are holding you back? And then most importantly, this is a step that a lot of people don't do, is they don't actually, try and implement a practical plan for you to overcome those barriers, right? Just so, people just keep going month in, month out. They know the problems that they have, but they don't actually do anything to change it. They're kind of just sitting there and hoping that their willpower, will be strong enough. But that's not usually going to be the case, okay? So we want to try and get practical here, try and think of some kind of innovative or creative ways in which you can overcome those barriers. Now, as always, if you need any help with this, if there's some barriers that you think are holding you back, but you're not quite sure maybe what you could do. As always, please feel free to jump in the community. I can pretty much guarantee you someone else or many people would have gone through the same problems that you're having. And as always, reach out to me and I'll see if I can help you as well with any plans that we can implement to try and see if we can get you to go through those barriers and stop potentially forming any of those mistakes. And of course, also, what wins have you obtained this month? There will always be wins there no matter what. Even if you think you've had the worst fucking month ever, I guarantee if you look hard enough, you would have grown, you would have got key lessons, right? Losses are lessons. There's always a lesson there if you looked hard enough. So make sure you celebrate that. Make sure you celebrate you've come through the month, right? You haven't blown an account. You still, still got your health, whatever. Put your wins in here and make sure you end that month on a high. So you're bringing that momentum and that motivation into the following month. So then once you've done your monthly review, of course, repeat the same process. And then we have our quarterly reviews as well, okay? So exact same thing. You'd obviously put in your total statistics for that quarter. And there's a few more questions within here, right? Now, one thing I think is always important to do is to constantly remind yourself, your motivations and what is driving you to succeed as a trader. Just find that this kind of really helps to focus and sharpen the mind. Obviously, your motivations will slightly evolve and grow as you grow as a person, right? And as your life changes. But it's good to just reflect on this, for obvious reasons. Then obviously talk about here, what have you actually implemented this month to improve your performance? Okay, that will kind of be closely related to the things that you have implemented to help you overcome those barriers that you have identified were holding you back when you were doing your monthly reviews, right? So you can put those into here. Then what are the major trading lessons you have learned? So this is kind of where you want to, I guess, summarize the key lessons that you had from all of your weekly key lessons and all of your monthly key lessons, kind of try and bring out the main ones here. You'll often find that, from if you were to copy and paste all of your weekly and monthly lessons into here, it would be a hell of a long list, but you would see that it would be kind of probably 3 or 4, key categories that all of those lessons could be filtered into. So then you want to obviously just bring those 3 or 4 out here and just summarize it here. It's just a really good way to do that. And then obviously now, looking back over the quarter, you can kind of, again, you're answering the same questions here, right, as you would be on your weekly and monthly reviews, but you're just having that even more bird's eye view, and you're seeing kind of what are those real, long-term things that are repeating here from a quarterly perspective that you need to try and overcome, okay? Now, I'm sure over the space of 3 months, especially if you're quite an active trader, there would have been some, low points during that time. Have a reflection on that, but more importantly, what are you going to do? What things can you put in place to try and prevent that from reoccurring? And then the flip side to that, what is the high point? Okay, there will always be a high point there. Even if you think you haven't, I guarantee there will be. There may be shit tons of them. Put them all here. This is your time to celebrate them. Celebrate the hard work you've been putting in. And then again, importantly, don't just hope, on faith. Get practical here. What are you going to do, right? Whether that's creating a certain environment or whatever, to ensure that those wins repeat again in the future. So this is why you need to spend the time really reflecting, what were those wins? Why did those wins happen? Was it because, everything was going great in terms of you were consistent with getting to bed early, you were consistent with eating healthy, you were consistent with working out, you weren't drinking or whatever, right? They're the things you need to think about and make sure that you're doing those again so you can repeat that performance in the market as best, as possible. And then what area of your trade plan have you not developed to its fullest potential, okay? You will always know at this point, especially after a quarter and 3 months worth of trading, you will have a very good idea of what bits of your trade plan you think you need to flesh out a bit more, or you don't have quite big enough confidence in, or you need to build some more rules, or you need to go and test, okay? And this will kind of feed into what is the one main area of your trading that you can focus on the next quarter that is going to bring the single biggest improvement to your results. Now, I often find you can have tons of key lessons and everything, and if you try and kind of correct all of them at once, it can be a little bit overwhelming. But actually, if you kind of just take that one big thing, the Pareto rule, the 80-20, what is that one 20% thing that is going to have the biggest impact on 80% of my results? And that can be your main big goal for that quarter, right? To try and nail and focus on, test, improve, refine, whatever. That is going to make sure your next quarter is going to be even better than the one you just had. Now, that doesn't always, like I said in the previous lesson, that doesn't always mean it's going to be reflected in your P&L, but you'll notice it, right? Whether you stop making those same mistakes or you feel more confident in your management or whatever, they're the types of qualitative things that you are going to be looking for. And of course, very similarly, that will all then feed into your annual review. I won't go through all of these questions, but it's very similar to your quarterly review, where you'll then be, read through all of your quarterly reviews again, and then you can answer these when you are, putting your feet up at the end of the year, and you're getting ready to smash the preceding year. So yeah, that kind of wraps it up in terms of I think a pretty good process for trying to combine the more sort of quantitative and both the qualitative side all in one place kind of on Notion. So obviously it doesn't have quite the same capabilities as some automated software or Excel, for instance, in terms of recording quantitative data, but I think this is a pretty decent start, especially for the qualitative side of things. So yeah, take this away. Remember, again, I will repeat this. If you want to kind of change this and edit any of this, make sure you actually do that in here, the one that's in the where it will generate the new template for you. Okay. And yeah, if you do kind of come up with something a bit more interesting or a bit better, or your own creation, that's a bit more tailored towards your style of trading, please feel free to share that in the community, as I'm sure others will also benefit from that. Enjoy.